Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
It's very prudent to be cautious right now and to be more worried about the return of your capital than return on your capital.
Hello, everyone. I am Chris Martinson. Welcome to this episode of Finance U. I'm here again with Paul Kiker of Kiker Wealth Management. Today, we're going to be talking about, well, what's going on with China, the tariff tiffs. They're not over at this point in time. And also, there's some weakness in the jobs numbers. We want to look at the dollar and maybe a couple other things in the credit markets. So we're going to discuss all things market related, and they've been perplexing and weird and a little off. Paul, it's a tale of two worlds. The markets keep going up, and the number of people I talk to from all walks of life and all levels of sophistication aren't buying it. Remember we talked about the kayfabe markets a while ago? I'm running into more and more people, and this isn't me leading the witness. I just ask, like, what do you think of these markets? And more people are going, I think they're full of S, you know? They don't quite get it, right? So
That's right. I'm seeing the same thing just in the average individual that I run into. They're like, hey, this is great. My account's going up, but how can this be sustainable? Like something doesn't feel right.
Yep.
And this is an area, I think it's all technical, Chris. I think it's technical flows. You know, one thing that Mike Green or Professor Plum, that he's highlighted for quite some time is just passive investing is just, you know, price insensitive buyers. As long as employment remains, people are into the S&P 500. That's part of it. You've got the options market that's ruling a lot of things, and it pins these prices where the market tends to work its way over there. And so I think a lot of this is technical. Now, liquidity's easing a little bit around the globe, and, you know, there's excess optimism, but everything's changed under the surface compared to where we've been over the past 10 years, really since the Great Crisis. But yet investors are retail's near panic buying. We've seen record hedge funds moving in. There's a lot of technical that's taking place while they're not paying attention to what's taking place under the surface in the market.
Well, I mean, you know, there's all this hoopla and around, there's always a story, right? And I'm impressed, Paul, how we jump from one story to the next. Tulip bulbs, railroads, housing, and now it's AI, all things AI. I think you've probably seen them on Zero Hedge, these breathless articles by UBS and Citi and all the rest, saying that they think that somewhere between 20 and 50 gigawatts of new installed data centers are going in. And so a gigawatt meaning that 1 billion watts of power is going to be consumed by that data center if it's a gigawatt center. And to put that in context, they were saying there's about 30 to 50 billion dollars of expenditure that has to go into each gigawatt.
Wow.
So that means at $50 times 20, I can do the math in my head. That's $1 trillion. So they're looking at, you know, is it possible for NVIDIA to have, you know, tap into $1 trillion revenue market? I'm still, Paul, I'm that guy. I was that guy in 1997, 98 saying, eyeballs? Pets.com? Are you sure? You know? Oh, you don't get it, Chris. You don't understand, right? I'm still struggling. So, Paul, what is the business case? We spend $1 trillion taking natural gas, turning it into electrons, making that electrons go into waste heat in a data center, and we get what out of there? We get some information, they say. What do we do with that information that's worth $1 trillion? How do we get our money back?
That I haven't figured out yet. And the ramifications as it trickles down through the economy. If all the jobs are replaced as they're stating that they will be, that's going to hit the most educated class, right? Your plumbers and your construction individuals are going to be in great shape, but how good a shape are they going to be in if you don't have the wealthy that are building these massive houses and building all these extra rental apartments? It's deflationary by nature, ultimately, if what they're saying is going to occur occurs. And furthermore, if they're reinvesting all of that back into the building of the infrastructure, they're going to have to redirect some of those dollars potentially from these record stock buybacks, which has supported the market. So I don't know how we get this Goldilocks or cinematic outcome, you know, in the movies where you always get the 1% outcome for the other 999% times that you would have passed away, or 99% of the time that you would have passed away with the calamity.
Well, it's official now. Even Elon Musk has come forward saying exactly what we said last week, that Trump et al. Have thrown in the towel on trying to rein in government deficit spending, just gave up the project. And now they're trying to reshape this as, oh, we're going to grow the bottom line. We're going to grow revenue and make this all okay. And of course, there's a lot of skepticism around that. But Elon just came out and said that he's just aghast. He thinks this spending bill is an abomination because it really seems to throw future growth under, well, the future of the country, really under the wheels of the bus. So with that said, government deficit spending is constructive. I'm expecting a pretty hot GDP reading this second quarter because we're not importing as much. We'll get to that data in just a second. And as you know, GDP is supposed to be all this economic activity, but it's exports minus imports, right? So you take that out. If you're importing less, you don't subtract as much I from the E, the exports minus imports. So there's going to be less of a subtraction because we're not importing. That gets counted as a positive in the GDP requirement, but you might notice that's fewer people buying and spending, which sounds like economic activity. So it's kind of a weird thing, how they measure GDP. And also the front of that is it's G plus these other things. That's government. So the government has been spending like drunken sailors. Fewer imports. It's going to be a blockbuster GDP report. That's what I think is coming.
Yeah, well, Atlanta Nowcast GDP is projecting that it's going to be a great number for this quarter. So not surprising with things rebalancing back around from what we're seeing right now in this fiscal stimulus. But back to Elon Musk. I've been on the fence with Elon Musk for quite some time. Obviously he's brilliant. He's done some unbelievable things, but is he really genuine? And I like to see the actions over the long term for what happens with someone. The fact that he's this angry, that he's just can't take it anymore. I think he said, I can't stay silent anymore. Isn't that exactly what he said? Mm-hmm. Mm-hmm. And he's raging against this tells me that he genuinely wanted to make a difference to try to steer the direction of this country. He's smart enough to see where this is going. And he's trying to wake people up, it seems. And that gives me hope that at least somebody in a position of power is willing to rage against the machine at this point.
Ray Dalio gave us warnings. Jamie Dimon, CEO of JP Morgan, gave us warnings. I've seen a lot of heavyweights come out lately and say, hey, this is no good. The bond market's going to break. Something's going to happen. We're not going to like it, But I see only bipartisan support for spending more. They're very clear about that. No Doge savings. Let's spend more. Both parties are pretty well in lockstep around that. Minus 3, maybe 4 people in total. You got Massey, Johnson, Paul. You got a few, but that's it, really. Mm-hmm.
Well, and the problem is, Chris, is what concerns me. The average person's not going to change their behavior until the pain of changing or the threat of the pain of changing is easier than the path of staying the same. And for all these career politicians that have been in there, have been riding this liquidity wave, the Fed's been able to print, they've had low probability outcomes that have been in their benefit, the benefit of them being in power. I just don't see, there's not enough pain for them yet to change. I mean, nobody's gone to jail for the decisions of the past. 2008, there weren't any consequences. We haven't seen any of these politicians laid bare for wherever that money was going that Doge has been finding and kind of cutting out of USAID. So what stick is there? What stick has been delivered to get these politicians to make a difference? And the problem is, I think they're so disconnected from reality and they're so narcissistic in their behavior now, and greedy, I guess, and their ability to recirculate these dollars back to them, even if it's just the praise of their constituents. Oh, you've gotten me money, instead of standing up, being a fiduciary and leading this country. And the longer this goes on, the more painful the ultimate outcome is going to be.
Agreed. And Paul, as soon as we come back, I want to talk about this. I want to talk about the China tariff tiffs. There's a lot going on here. We'll get back to this just as soon as we return from this message. The markets are a ticking time bomb. Volatility is spiking, trade wars have broken out, and most investors are sleepwalking into disaster. Many portfolio strategies perform poorly during times like these. At Peak Financial Investing, however, we don't gamble with your future. Our registered investment advisory connects you with battle-tested wealth managers who reject outdated models and embrace active management, strategies proven to navigate chaos, and who aren't afraid to discuss things like the great taking, or maybe the importance of protecting your wealth with gold. Without the right approach and with the wrong advisor, you're risking, well, everything. Don't wait for the crash to act. Visit peakfinancialinvesting.com right now to schedule a free consultation and discuss your particular situation. Take control of your wealth before the markets take it from you. Again, that's peakfinancialinvesting.com, and I'm Dr. Chris Martenson, urging you to act now. All right, now we're back. Paul, can we talk about this real quick? Because I think this is still flying under the radar. There's a lot going on. You know, there's Ukraine, drone bombings, there's all the political machinations. This hasn't been fixed. I think people just move on and they're like, didn't Trump rewound tariff amounts with China? That's over, right? It's not over. So the most recent data we have, first is the number of TEUs, which is a 20-foot container. So that's how they measure them. You can see here measuring them in by the millions. This is a very low amount. So there's, in terms of volume, not a lot coming over. And this is just number of ships, vessel count. Here you can see, what are we, about 35. Also a very low amount. So this is where it was supposed to have been fixed. But look what's happened the past few weeks here, right? We're not getting the volumes and it's not coming in. And by the way, you know, China needs us. They need our dollars. You know, I'm like, maybe we need their stuff more than they need our dollars. Not clear. So this is, the pink stuff is machinery, telecoms, vehicles. It's actually high value added tech, including semiconductors. And the blue stuff is fuels. These are more complex products heading out to the right on this chart, and it's less complex. The U.S. mostly ships fuels to China and a little bit of high-tech stuff, but China mostly sends us very high-tech stuff that is complex manufactured products. So when you look at this, it's kind of like who needs who more. You know, fuels, you can get them anywhere. It's a very, it's a fungible market out there. I was going to say liquid, but that would have been too close. And then last week I read this, that Trump team is pushing for a G-call. We need a G-call. Hey, can we get a call? Why would Trump want the call? I think because of this. They're not shipping stuff. This kind of looks intentional to me. And by the way, just to put it in perspective, China built more commercial ships in the year of 2024 than the U.S. has built since World War II. Their shipbuilding is unbelievable, right? Like, for instance, BYD is starting to eat, a lot of car makers' lunches. They make a very nice product at a very reasonable price. So they just launched their own cargo ship for vehicles. And first stop, I guess, they're going to Brazil. So it's the largest car carrier ship in the world. So they just launched that because they got so many cars to ship, mostly to Europe and South America. And, if you do want a 220,000 ton, that's a 24,000 plus TEU container ship. Who do you go to? Well, there's only one country building them. In fact, that's China's Yangjiang shipyard. That's where you go. And I thought we could just talk about that. Like, this is here. Let me turn this off because we won't need the sound on this. But this is just a time lapse of China building a cruise ship. That's how they do it. But every one of those blocks that goes on there, Paul, every one of those little things that crane just sort of like brings in, gets welded on. Every one of those has to be perfectly engineered. It's got wiring, it's got plumbing, it's got a whole layout. Everything has to happen. It's just a symphony that has to, occur in a very, very precise order. Obviously, a lot of countries can build ships, but this idea that China is just sort of copying people, like, no, they're way beyond this at this point in time. They are building the largest ships, and they're doing it in the fastest pace, and they are doing it in really good style. So this is the final finish out here. You got to get the paint on, and they're putting all the rooms together because this is a cruise ship, so those are probably pretty nicely tricked out rooms they'll have everything. They'll get it all done. And hey, there you go. One more cruise ship out on the ocean. See ya. So I thought that was just kind of a fun little thing to put this in context. And this is where we're at in the overall China story right now, where this is a woman in China at a store talking about stuff.
Hello from China. So I'm in a grocery store right now, and I wanted to show you how the American tariffs are affecting Chinese customers. So I was gonna get some beef for dinner tonight, and I saw this. So what used to be here is American beef, but now, as you can see, it says Australian beef. And I did look around. I couldn't find one single pack of beef from America. So I guess China just stopped buying beef from America and it went straight to Australia. So the whole idea that China is hurting because of the American tariffs, well, they're not, because they're not as dependent on the US. In fact, only 18% of Chinese imports come from America. And for stuff like beef and soy, they can just go somewhere else easily. So I guess I'm having Australian beef for dinner tonight instead of American beef. And honestly, because of the food quality, I probably trust Australian beef better. And this box of beef right here is 50 RMB, which is about $7 US. So to answer the question, China ain't hurting. And if anything, I think we're probably doing even better, because now that we are better beef that tastes better and at a better price. So thank you, Trump, for that.
Losing markets is bad. So this just came in on today, Paul. I found this as I was prepping for this. Trump apparently is now obsessed about having a call with China's Xi this week to hammer out a trade deal. And is he obsessed? I think so. I think so because 2:17 in the morning, Trump is obsessively tweeting about President Xi. He says, I like President Xi of China. Always have, always will, but he's very tough and extremely hard to make a deal with. 2:17 in the morning. I think he's got Xi on the mind.
That's pretty incredible. I saw that tweet, but I did not catch that it was 2:17 in the morning. And all I could think of was he's either trying to negotiate hard and save face for Xi in front of his own citizenry, or he's realizing that he doesn't quite have as much leverage over China as he thought that he did.
Well, if they've already dialed away from U.S. beef, and again, that's an anecdote. It could be one store. Don't know. But I do take something into those macro shipping statistics that those are way down. That speaks to that's going to bite on our economy. Even though we'll get this ripping Q2 GDP, it'll look good on the surface, but underneath it, Paul, losing those imports is a negative overall to our economy.
And that's just another sign that everything under the surface has changed, but the markets are moving on this technical liquidity. Oh, the Fed's going to save the day, Trump's going to save the day, and I hope that it works out. But when you've got one of the most overvalued markets in history moving on technicalities, with investors breaking record numbers of piling in the market, and the hedge funds getting squeezed in, is what it looks like. A lot of the market action from the last month was on several days. It looks like what's called a technical stop in, right? So price hits a certain level, it forces them to buy, which gives this illusion in the markets that, oh, this is going to work out great, that we don't have anything to worry about.
I don't think that it's clearly not over with China if we have these trade volumes falling off like this. I mean, this affects port activity. This affects obviously truckers, but obviously it's going to affect eventually what's available for sale in stores. And I don't see how it results in more economic activity longer term. But this is really starting to shape up where I don't know if Trump's going to be able to back down. And like Xi is basically saying, we're holding some cards here too, and we're willing to take some pain on this at this stage. Yeah. Do they need our dollars more than we need their high value add manufactured products?
That's a good question. I would think not. I don't, that's a little outside of my realm of expertise, but I would think not. I mean, in the negotiating, and they can build ships like that. Do we have any videos of anything in America outside of technology being built that way? Yes, we're leading in technology, but you still need machines and goods and transportation capability. And God forbid you end up into a war, you've got to be able to produce. Have we graduated the number of engineers? All I could think of when you were showing that video, I was racking my brain about the ship being built, time-lapse
Yeah.
video. I was racking my brain trying to come up with the numbers, and I can't capture the numbers, but I remember somewhere around 2010, 11, and 12. I don't know what the number was, but China was graduating, even within the U.S. and within their country, about tens of thousands of more individuals with engineering degrees than what was happening in the United States. When we're getting liberal arts degrees, we're getting all of these basically worthless degrees. And we're seeing the long-term results of that now with their capabilities, with all of these engineers and educated individuals that can produce things that we can't produce in America anymore. Much quicker, much faster, and much more efficient, and far cheaper.
And you know, so we've dialed it up. Apparently, we caught 2 Chinese terrorists who were bringing in some sort of a mold. The FBI was all over that. I have to endeavor to point out to people, this wasn't like a mold that's never existed. We have 200 separate genetic subspecies of that mold in the United States already. I'm not sure that this was a weaponized version of this mold. I have no idea. I don't think it was. But anyway, they made a big deal out of that. We've made a big deal as well, Trump has, of making Chinese students feel unwelcome here in the United States, right? And revoking visas at Harvard and things like that. So this came up. This isn't President Xi. This is not actually Xi. He doesn't tweet, okay? But I thought somebody captured a reasonable sort of a perspective on it, as speaking as if it were President Xi, said, quote, "President Trump, your diplomacy is a mess. First, you hammered the world with random tariffs out of nowhere. We responded fairly. After some back and forth, you went berserk, so we tuned you out. And when your port sat empty, you panicked and begged to talk. We weren't sure, but your team kept pushing, so we said, fine, Geneva, since we were on meeting the Europeans anyway. Bessent flew out on a Saturday, actually made sense. We shook on it. 2 weeks later, for no reason, your administration banned chip exports, blocked EDA sales, and started revoking Chinese student visas. So we figured the war was back on, cut some minerals. Now you're upset. What's wrong with your people, right? So that's sort of the view, is like it's just sort of feeling. I could see from their perspective, it's like, who are we negotiating with, and what is the aim here? It's feeling a little random at this point in time, to me, as an outsider. If there's a method to the madness, it's that 3D, 4D chess thing, and I don't get it. And I'm not a negotiator of any sort, but it does feel tricky to make plans around.
And that uncertainty has got to deliver some damage to the global economy. And is it arrogance, Chris? Is it just that Trump was so arrogant that he believed that, hey, I'm going to march right in there and everybody's going to do exactly what I want them to do? I'm not a very good negotiator. Holly's a better, when we go to purchase a car, I have my mindset. And if I don't get to that number, I don't buy it, because I don't like that back and forth. So I don't know the art of the deal when it comes to that perspective, but there's, that was a very good perspective. Very clear in its analysis. And I kind of feel the same way when it came to what he promised as far as this big bloated bill that came out. Hey, we're going to get spending under control. We're going to deal with this. And the exact opposite took place.
Sometimes the simplest explanation is the right one. I think this is just looking a little shoot from the hip. It just feels a little sort of day by day, sort of little make it up as we go along, kind of a vibe. But I think your analysis is right. I think my guess is Trump believed that the United States could bully anybody we needed to. I think you can do that to Canada. I think you can do that to Venezuela. Gets a little trickier with Europe, but I don't think you can do that with China. No. They're too proud and they have too many cards in this story. And I never bought the idea. A lot of people said they need us more than we need them. Their system would crumble without U.S. dollars. I'm like, but U.S. dollars is it's a fiction. I mean, so what if a Chinese bank has U.S. dollars in the system? That's only helpful to them if they need to use them for something outside of their system. Having dollars in their system doesn't do anything for them. It's just an entry. In fact, they may not even be in their system. They'll be recorded in an Oracle database at the New York Fed saying China owns $736 billion of U.S. treasuries. That's what it means. Oh, they need us because there's an Oracle database in New York.
Right.
On a server somewhere that has some zeros and ones on it. What would China do if they didn't have that? Right. I don't track that.
Here's another perspective too, Chris. Maybe that was the case 10 years ago when they could have, when the threat of hey, we'll lock you out of the SWIFT system. We'll sanction you to death. But one of the things that we've seen that China, Russia, Brazil, South Africa has their issues, but the BRICS nations have done is the foundation for the unit, their own interbanking system. Maybe they're to the point now that they don't have to worry about being locked out of the SWIFT system because they're close enough to where with a lot less pain, they could implement their own alternative trading system to the dollar, because we're already seeing that within their trading partners. And if I had the ability to produce everything like they do, I wouldn't worry so much about the dollars in the bank, because if all you have is the dollars in the bank and you don't have the ability to produce, and that the purchasing power was attacked, then how are you going to rebuild the ability to produce things? If we were to hit their pocketbook in some manner, they can find other alternative sources because they don't have to create the foundation to produce the goods that the world's wanting to buy at this point and that the U.S. has to buy.
Yep. So I do think this is probably why Trump's up at 2:17 in the morning, tweeting away about Xi being a tough negotiator, meaning he has the point of view and you have one, and you're going to have to come to terms on that. I think that's what tough means. So, but that's actually pretty dramatic. These are, I mean, yeah, technically they're at all-time new lows, but I mean, we're not supposed to be down in this range down here. We're supposed to be, the normal range is between 50 and 70 ships, right? Mm-hmm. And we're down here at the mid 30s, right? So that's a lot. That's a lot of traffic not happening. And it was pretty intense seeing, we had that big rebound up here through March and middle of April, but then it's just totally tanked ever since. I don't know if that's intentional, if that's people on our side who said we don't need the ships, we're not going to order stuff, or if it's just uncertainty on both sides, or if it's an active policy. I'm not clear on that yet. I don't know what's happening here, but I think that's driving the story here.
Well, and could it be a combination of two things? You obviously had the tariff front running that was taking place in April there, and then you had the slowdown. Mm-hmm. And what if you had all of that front running to build that inventory, and then all of a sudden you have the economy slowing under the surface that's also reducing some of that demand with them refusing to ship? So we're not really going to understand that completely until we get another 6 months out to see if it rebounds up. But that's another thing to be worried about, to pay attention to be concerned about.
Well, let's look at some of the signs. This just came out today as well. Private sector. So ADP does a guess. That's the payroll processing firm. ADP does a guess, usually two to 4 days in advance of whatever the BLS is going to come out with. So this is an advanced look at what they think private payrolls will be, and they're just 37,000 in May, and way below the Dow Jones forecast for 110,000, lowest monthly job total since March of 23, not that long ago. Those are kind of weak, right there.
That is weak, especially after the JOLTS number came out and surprised to the upside.
Yeah.
And I really enjoyed the conversations that was around that, the debate around the JOLTS number. Are we getting back to a more realistic picture of what hiring actually is, or job openings with the lack of illegal immigration coming in? But that's a much lower number. And that came out today, you said? I didn't catch that number. So
in response to that, President Trump said, he tweeted out, he said, he calls him too late Powell. He said, too late Fed Chair Powell is unbelievable that he's waiting and not cutting rates. He must now lower the interest rate. So that's what he said in response to this. So Trump's now, back riding herd on Powell, asking him to cut rates. Make of that what you will.
Speaking of cutting rates and where Powell is, I read a pretty interesting, I'm in the middle of the report, and I was telling you before we started, I should have read it yesterday because I only got halfway through it. But this analyst was pointing out the fact that, yes, Powell's keeping rates high, and if he's not anticipating where we're going to go, it may hold, this liquidity, and higher rates actually is paying savers a lot. The baby boomers are getting more money, so that is extra liquidity that's coming into the economy, but it's having an impact on housing. It's having an impact in several other areas. But the question is, if he was political in his cuts last, 6 months ago now, nearly a year ago, coming into the election, if he's actually acting politically at this point and refusing to look at the slowing that's taking place under the surface, the other warnings that are taking place, is he holding them a little higher so that it impacts in 2026 right before the midterm elections? That's the question that was raised by this analyst. I don't know. I don't know. But if that is the case and they're playing politics and they're going to stay higher for longer, that's one argument. Now, from my standpoint, markets are being very resilient right now. I would have been upset that they didn't cut rates at the last meeting. I would have been upset that they did cut rates if they had to cut rates. Right. So, I can't play both sides of the fence there, but I think they need to be ready if the data shows, and we may see some reason later in the year if that's the case. But then you got the bond market that's just refusing to have rates go lower. The bond market's saying we're worried about inflation from a long-term standpoint. Yeah, and they're demanding a higher premium.
Yeah, everybody's kind of walked from the 30-year bond, as we've said. I'll get to where I think some of the demand for the 10 years, just what we talked about. But Paul, as well, notice that last bullet point says regarding wages, the annual pay grew at a 4.5% rate for those remaining in their positions and at a 7% rate for job changers. So switch jobs, everybody. And that's a fairly high rate, though. So that's going to bleed into inflation numbers at some point. Mm-hmm. So minimum increase of annual wages 4.5%, and then 7% if you are a job jumper.
That's a big deal.
Well, that's pretty inflationary.
Yeah. And good talent's hard to find. It just is. So there has to be a premium for good talent that's willing to make those moves.
Yep. So this is what the ADP report looks like over time. And so here we're going back to 2021. And here you can see that where the private monthly in November of 2024 was just a little nudge over 200,000, it's sort of been bleeding off here ever since. So I don't think this is just some recent weakness. It's sort of been showing up for a while.
That's a trend.
Probably, yeah, it looks like a trend. Doesn't it?
It sure does. Looks like a short-term trend. And it looks like the slow trend on mortgage defaults at this point as well is slowly creeping up in the other direction.
Now, I haven't seen that data. If you have that, let me know. I've got this from Bravos Research, had a nice thread. There's the thread post down there, the link to it. But they said, hey, credit card debt nearing 1.1 trillion. Woo! You have your bumps here. You've got 2000. You've got the Great Financial Crisis. This was coming into COVID, but then off it goes, right? So what's the opposite side of having lots and lots of credit card debt? First, it's starting to the change year-over-year change in credit card debt starting to fall, right? And it typically only ever goes down or below zero for sure in the context of a recession. So it's heading down. People are taking out less and less, just saturated with credit. I get it. And then credit card defaults at record levels. So that fits with your mortgage data for sure. But the point here is I think we're looking at consumers that feel a little tapped out. It happens at the end of a cycle anyway, right? Everybody's sort of lived beyond their means for a bit. The cycle turns, but people don't adjust their spending in time, right? People lose their jobs, maintain their living standards. They don't see that the change is coming, so they just keep sailing along at their current expenditure level and then later have to dial it back, under fire. But this pretty clearly says that's record levels of credit card default. I don't know how that just gets buried, but it just does.
I don't either, unless there's just enough liquidity and profits in the system right now that can absorb that for the moment. And I did find, let's see, early delinquencies. So this was in the Mag King's most recent newsletter that I've been working my way through. What I'm showing here, this was updated May the 30th. The black line is autos. Nothing major there. You can see that's creeped up over the past year or so. That shows your credit card debt that's increasing. So this isn't the high level. This is the loan type percent. So this is the U.S. New York Fed Equifax Flow Early Delinquency 30 plus by loan type percentage. So that's worked its way up. Credit cards are at the highest. Your total is starting to creep up and accelerate. Of course, you see student loans there. That moratorium that was in place for a while. Now that's all of a sudden. But what I've been paying to is mortgage. Now it's not at a high level like we had in late 2007 or early 2007, but it is starting to creep up back to where we were in 2019. The question is, will that accelerate from this point forward? When you take into consideration right now how many people locked in the 2.5% to 3.5% mortgage rates, they're not going to default if they can help that. So this is something, maybe back here you're choosing a little bit more. This is something, the last thing you want to do is default on a rate that's low, because you may never see rates that low again. And that's my concern. There's a lot of people out there that are overly aggressive in their housing right now, expecting that hey, rates are going to go lower. I still hear real estate agents saying rates are going to get back down. Go ahead and buy now, because when they cut rates, you'll be able to refinance at a lower rate. That may not necessarily be the case. They may go down a little bit, but it's highly unlikely unless we have an absolute just economic crisis, depression, that we see them at 2.5%. Even then, it may not be a deflationary recession, depression. It could still be inflationary or stagflationary, and rates stay higher.
Well, and if that happens, you may or may not want to be sitting on a big mortgage payment, regardless of its interest rate.
That's right.
All things depending. Well, with credit card defaults kind of at record levels, which is a little different than what was on your chart, so I wonder what the difference is. But we see, too, from the Bravos research that savings are contracting. So net saving as a percent of gross national income. It's a big, complicated way they put this statistic together. But it's basically, this is like really low. Normal 40s, 50s, 60s, 70s, back when we had like high net energy oil and things were expansionary and we had a lot of value add products and services and manufacturing in this country, people were able to save about 10% on average over that period of time. It's just been steadily eroding. And here we see it's basically hovering down near zero. And so if you looked at it this way, it would say, excess savings. So there was a huge amount of excess savings poured into the system for COVID. That's all this green stuff. And then people spent through that, all those stimmy checks, and then they've been eating into that. And so it turns out the excess savings are just about gone. And so when those are gone, baby, they're gone. And I don't see, we're not super, so, I don't know why that dotted line says elevated levels. Elevated to me is 4 and above. But anyway, the point here is that defaults, the rate of defaults on consumer loans is rising, like you just said, Paul. It's rising. I don't think it's not nearly where it was back in 2008 and all that stuff. It's got a long way to go yet, but it's rising. That's the point here. So
it is rising. Kind
of a tapped out consumer, put too much on their credit card, low savings, and starting to choke a little on their debt is not firm footing for a big rally of consumer expenditures. But maybe the consumer doesn't matter like it used to. We used to have an economy based on consumption. Now apparently it's based on information. A totally different thing.
Right. And that information has made things more efficient. But again, my question is, let's say it moves faster than what it did during the internet bubble when you were talking about, eyeballs that were on the screen. You go 14 years later, Amazon continued to grow, but investors priced in the impact of those internet companies way too early. It was revolutionary. So let's say it takes 7 years from this point. There still has to be some repricing in the interim period. And the question is the consumer tapped out? I go back to the 70s. They clearly remembered what happened during the Great Depression a lot better than what we did here. And they didn't want to be in a position to where they were wiped out through a normal economic recession. So yes, they saved more. Is it arrogance? Part of it, the part of our society, is it arrogance? They just want to spend everything because we're in this consumer society. And then you've got another part of the society that the inflation is eaten into their disposable income to the point that they don't have any left over to save. I am seeing, a lot of younger individuals that I'll counsel from time to time that every excess amount of money that they had is going away because of insurance costs going up, repairs going up, the cost of everything that's taking place. So inflation seems to be finally starting to erode the spendable power that people have, and their ability to save.
I think the theme that's sort of emerged here is that there's just so much uncertainty because I don't know what's going which way or who's doing what. I am now 99 in 44 100% sure that our markets are mostly not transparent, and mostly the playgrounds of people who are able to wang them around.
Mm-hmm.
Not in the interest of fair and open and legitimate price discovery between buyers and sellers, but because they make money by moving the prices hither and yon, right? You mentioned before that there might be a big option stack sitting out there that says, listen, I don't care what the news is. I don't care about anything else. Somebody's going to lose a lot of money unless the cash markets settle at that number, and they settle at that number, Surprise.
Right. They work those technical flows, and in the liquidity, the global easing cycle that's taking place out there, the excess, continued reckless, foolish fiscal package that we have in this big BBV, big bloated bill. I can't call it anything else, guys. I know it's the big beautiful bill is the technical name. But those are technicalities that the market's paying attention to instead of reality. And I think on top of that, Chris, one thing that we've seen time and time again is you've got those of us and the individuals that are really trying to manage money and invest from a long-term standpoint. They are not the most popular by any means at all right now, because this passive investing and indexing and the marketing by the Vanguards, the Fidelities, all these companies that are pushing their products out there because they're very profitable for them, that, hey, you've got to beat this arbitrary index. And most people don't know enough about their situation to know what they need to do to be successful. So, of course, they're going to gravitate towards this arbitrary index. So you've got a lot of managers out there that are a smaller minority by far at this point, that they're going to be fired and replaced if they don't, keep up with that index. So there's this massive fear of missing out that's taking place when these technical options levels forces, these moves in the market, and you get this massive bounce that we've had that everybody's forced to pile in. There's very few people that have the wherewithal to take that path less traveled. And what concerns me is everybody goes over the cliff at the same time. My concern is risk is going to come back suddenly. Think about how fast, Liberation Day and the markets just melted down in that 20% period of time, that 20% level just quickly before most people could do anything. That's my concern as we get 6 or 12 months out from now, and all of a sudden people realize that it's not different this time. And I could be wrong in that case. But I can tell you this, it's very prudent to be cautious right now and to be more worried about the return of your capital than return on your capital.
I agree that there's two things related to all of these big moving parts for me in all of that, which, well, one has to be the dollar. I'll pull that up in a second because that's the other side of this. But I don't know if you've noticed, Paul, but gold has very sneakily been going back to its all-time highs, right? It's very close in there. If it closes here, this will be the new all-time high weekly close. So it's Wednesday, so we got a couple days left in here, right? But you can see like this bar is above any of those other weekly closes right there. And I do have this set. You can see here at the weekly. That's the W. So gold is that was this is a consolidation. This took a year and a half, right? This was a quarter. That was 3 months of consolidation. So that's short if it's going to go on past that. And I think the reason it's going to continue to roll here is because, let me pull the dollar up here real quick. This is on a weekly basis. You and I have talked about this, but we can clearly see it's weak down here. It's below 100. It's below 99. It's 98.79 as of this moment right now. And if it busts under here, it's going to run somewhere lower. And as I've mentioned before, it seems to hold up at the big round numbers, which would be 96, 98, 96, 94, 92, 90, and so on. There, I can find you support or resistance at pretty much all the round numbers. Yeah, for what it's worth. But the dollar's weak. So we got a weak dollar. We got bonds are pretty weak here. And this is the context we're going to throw more deficit spending by the U.S. government. They're going to argue over what's a cut, what's spending, what's not. It's more money being thrown out the door. With tax cuts, by the way, a lot of the money getting thrown out the door, a lot of the new deficit increases because of tax cuts. All of these things I think Trump likes, makes him feel popular, right? Gasoline's cheap, taxes are going down, and then there's this idea that somehow that leads to a lot of economic growth. And I've been stumped, Paul. I've been looking everywhere like, okay, how? Listen, you don't have to explain it to me. I might be a moron. I miss things all the time. But I'm just like, where? Like, which sector? Can we just do a sector? Housing. Autos? Farming. Retail?
Metals.
Metal? Like where's our growth going to come from? I'm just confused by that, you know? And so here was Scott Bessent doing the best he could to sort of get past that. See if you hear an explanation here that settles for you.
I'm a fiscal hawk, but I am also a realist. And the way to think about this is every $300 billion is 1% of GDP. And as the clip that you just said, or you just showed, where I said we didn't get here in a year, we're not going to get out of it in a year, that we have to bring this down gradually because we want to do two things. We want to cut and constrain spending, and we want to grow the economy. And what Senator Paul is asking for or advocating for, I think, could cause a sudden stop in the economy. So, I'm a deficit hawk, but I'm also a realist.
You say it could cause a sudden stop. You're saying that this is too radical of to flip the switch like this to cut. I mean, he probably wants to cut, a trillion or a couple trillion, right? You say that would be too dramatic.
Well, Robert, a trillion would be 3% of GDP.
Yeah. And that would, what would that do? I mean, because he's, I think he's a pretty smart guy. I have him on the show a lot. What do you believe that would do?
Well, look, what's important here is our debt to GDP. Yeah. So that if we don't grow, then we won't grow the tax base, and we're not going to grow revenues. We're not going to grow the economy. So we inherited a mess, and we have to constrain spending, cut spending, and then grow our way out of this.
So all I heard was he said, look, I know we're $1 trillion above trend because, COVID came along, emergency, and so they tacked $2 trillion of spending on, and we're way above the normal trend. Like I think it's easy to argue, can we just cut $1 trillion out and get back to the old levels of spend? Like, how bad were things in 2019 anyway, right? Not that bad. But he's saying if we do that, you have to understand that's going to shave 3% off of GDP, which is going to create a technical recession probably if we do that. So we have to keep government spending up, or the GDP is going to take a hit. And to fix all that, we're going to grow the GDP. They never say how, right? It's just tax policy.
Is that code that is that another way of saying we're just going to let inflation run a little bit hotter than normal, and we're going to erode this out? Is that what it is? Because what if we have a technical recession? Let's go back to 2019. Let's get it in order. And how about we cut regulations? This is interesting, Chris. I was shocked yesterday. So I have a friend that spent some time in China, and he's probably going to listen. So, but he was explaining to me he felt that it was easier to start businesses and be an entrepreneur in China. And than it is in the United States because they have the ability to go out without the excessive regulations that we have in the United States, which I would think we're more monopolized through our regulations from my perspective. And I could be wrong on this, but this is just my perspective and seeing what I see and clients having to deal with and what I deal with in my industry. The regulations we have in the United States we're told that they're for protecting the environment, doing all of this. I think it's to protect the monopolies of the big corporations that are lining the pockets of our politicians. But I was shocked because he spent quite some time explaining to me, and I thought about it for 2 or 3 days since, can't get it off my mind, of just the cost of their cars were nice cars for a lot more affordable prices that aren't able to be shipped into the United States for whatever reason, but they're shipped to Europe. And that the entrepreneurial, I can't talk today, guys, please forgive me, entrepreneurial abilities are easier in China right now to start businesses because they're not burdened with the regulations that we are. So how about we go back to 2019 spending, get rid of all this ridiculous regulation that's protecting the monopolies of larger companies and allow the entrepreneurial spirit within the United States and that creativity to come to the forefront, and let's grow out of it that way instead of telling us we're going to grow, but not how, which is really, we want to inflate this away, which is going to hurt retirees. It's going to hurt people's purchasing power. It's going to, they're just telling us that's what we're going to do.
Well, over time, our system of government has become very adversarial to private industry, citizens, all of that. Unless you're in on the gravy train, and you're got lots of donation money and all of that other stuff. Like you got good lobbying firms. And I was shocked. I was talking with a friend of mine who's decamped, lives over in Dubai. Said there's almost no taxes to speak of whatsoever. Obviously, they've got oil money to work on, but he said the government agencies there, quite shocking, took them time to get used to this, are actually helpful. Like that's their job, is to assist you, right? And you can actually call them up and expect to be assisted. And if they're not helping you enough, they will find a way to help you. I was just like, I don't even understand what you're saying. I hear the words, but the concepts, I don't. I don't.
That's a foreign concept to me. I could not imagine if I was called planning and zoning and they were actually helpful instead of attacking.
Could you imagine that? No, we just have to fight the whole thing. So I think I just retweeted this out. I mean, it was just sort of instructive to me. Yeah, from Wall Street Apes here. Same thing. So here outside of San Diego, they note there's 22 billion gallons of raw sewage. They can't figure it out. So they just, whatever, the city just dumps it into the ocean and off they go, right? Whereas you and I know that if I live in a state where the state won't allow me to use gray water, right? The stuff that's left over from washing out of sinks and out of, say, washing machines. You can't use that. Total no. Has to go into a state-approved Title V, installed by a hideously expensive septic design professional, which means they make holes in the ground the same way I would with an excavator, and put a pipe in it. Only it costs 10 times more once the licensed professional does it, right? Than it would cost you to do it yourself, which would be easy. Blah, blah. So, but it's like if the state wants to do it, what are we going to do? We're going to have to grant ourselves a mulligan on this one and put 22 billion gallons of raw sewage right into the ocean. Whereas if a private citizen or company tried to do that, of course, that would be a giant nightmare, right? You'd be put out of business.
The fines would bankrupt the company. There's no doubt about it. And depending upon how deep their pockets are. Mm-hmm. Rules.
Do you remember that time the EPA polluted like 5 miles of a river because they were dorking around with a mine and they accidentally dumped all the waste leachate into that river out west somewhere?
Was that
They investigated themselves, and I think they find themselves nothing. They said it happened. It was an accident.
That was outside of Durango, Colorado, wasn't it?
I think it was. Yeah.
And I had actually fly fished that river the year before that.
Had you really?
I sure had.
So tell me, how bad of a crime was that they committed?
We hadn't been back there after the impact, just because we assumed that it just destroyed the trout population for a period of time. But I think it was the Animas River, if I remember correctly, outside of Durango, Colorado.
Yep, I think that's right. Yep.
But
if they do it,
Yeah, rules for thee, but not for me. And that's the problem. Our government is supposed to serve the people. Our politicians are supposed to be fiduciaries for the people. They're supposed to be leaders in pointing out the right direction and having us endure a little bit of sacrifice now for a better tomorrow. But the problem is these politicians care more about being reelected and telling people what they want to hear instead of what they need to hear. And that never ends up with a good outcome. And the problem with these decisions, and I think it's hard, is because the markets have papered over everything. The Fed's been able to print like they've been able to print since 2008 because we had all of those deflationary forces. And yes, inflation was there, but we really didn't start seeing the inflation accelerate to the point that the average person really understands the pain of what inflation does just a little bit at this point. That they just think they can continue this forever, but everything has changed under the surface, but their behavior hasn't. So my concern is the fruit of all of this is going to be very severe, and it's going to hurt a lot of people that are going to be further convinced, by the death as soon as it happens, because at some point, if it's not completely different this time, what's changing under the surface? Global trade tensions, global money flows, deglobalization, the inflationary pressures. We have a risk moment that occurs, in a much faster fashion, that if people blink and even if they have a risk management strategy, if they don't stick to it, if they blink, then they're going to be impacted a lot more severely than they can imagine at this point. I don't think people are imagining enough the pain of what can unfold in the future because everybody's trying to embrace this optimism. One side, at least, is extremely optimistic that Trump's playing 4D chess and that he's going to be able to pull this off. But what I'm concerned about is he's not following through. He's actually doing some different things than what he told us that he was going to do. And I had high hopes that he was actually going to do what he said he was going to do. And I don't want us to experience pain. But I've studied enough historical cycles, and you have too, that the longer we put this off, instead of it being painful, it may be irrecoverable.
Yeah.
And I don't like being so negative, and I'm not a perma bear by any means at all. I'm extremely optimistic because there are unbelievable opportunities out there because of the distortions, especially in the commodity space and the international space. If we've got a weaker dollar, international investments are going to be good for those who have the ability to make those adaptations. They're going to protect their purchasing power far better than others. I'm just thinking big picture because we've got kids and, a grandkid on the way that I want a better future for. And I know you and all of the individuals that are listening to you care about the future of this country. And I don't know how to change it at this point because it seems like we're getting more of the same. But I'm also very concerned that investors are just going to be complacent. They're going to buy into the fact that, passive is the answer from this point forward. And it has been. But one thing about Wall Street is when you get to the top floor, that's why past performance doesn't guarantee future results. Too many investors are chasing that performance and they're looking in the rearview mirror, not taking into consideration what happened 10 years ago in that particular strategy was the perfect environment over the following 10 years to put them in that position of the number one returns at the top. But everything's changed under the surface, and there's another strategy that rotates up to the top because there are, even in a good economy, there are different cycles that unfold and different strategies benefit from those cycles, and that's why it's important to be adaptive. You've had this ability for the government to step in and quantitative easing and Operation Twist and print and get away with it that's pulled all this money into asset prices. It's also pulled money from the international markets into the U.S. because they're chasing performance. So your retirees are in general overweighted to U.S. equities and passively investing. International money flows have been overweighted to U.S. equities. And at some point that's going to change. We just don't know when it is. But I think we're a lot closer to that moment than anybody realizes.
Well, maybe exactly, and it's about all those cycles, and hey, cycles come and go, right? So know where you are in the cycle. That's a big portion, I know, of your risk managed strategy. But I just wanted to just want to maybe, I don't know if I have to listen to the whole thing, but, Ray Dalio, he's got that book, How Countries Go Broke. And trust me, this isn't Ray saying I got to sell more books. I think he's like the 17th richest guy in the world, so I don't know that a book sale is really what he's after. He's here to try and help. That he's like at the end of his career, and he's like, I just want to help, and here he is explaining it.
Very simple terms. The big cycle is like the period from one period of great change and turbulence in which various systems or orders are changed through fighting, typically. And then through that evolutionary process, there is a process that gets us to another period of breakdown. The last big cycle began in 1945, at the end of World War II. In that world order, there are shorter-term cycles, like the economic and political cycles. The economic cycles have lasted for about 6 years, from one recession to the next recession. And they transpire in a way where, the economy is weak. Central banks put a lot of money and credit into it. That causes markets to go up. There's a lot of spending. It gets too hot. Inflation rises. They tighten monetary policy, and that causes the economy to go down into recession. And since 1945, there have been 12 and a half of those. And we sometimes don't pay as much attention to the big cycle when they reach excesses, such as debt excesses, because debts rise relative to incomes like this. If you were to look at a chart of most countries, their debts keep rising relative to their incomes. But the incomes are needed to pay the debts. And so when you get to a point where the debts are high relative to the incomes, and debt service is very expensive and starts to crowd out other spending, and investors do not want to hold the debt as much because the debt does not provide them the good returns, and they start to sell that debt, you begin to have a change in that big debt cycle. And that big debt cycle typically corresponds with the big domestic political and social cycle, because wealth and well-being matter to people. And when there's disruption to the wealth and well-being of that, then you have the political disruption, such as what we're experiencing now. And so there's more fighting over wealth and power and so on. And these things come together. Then that creates the new conflicts, the new big conflicts, the changes and breaking down of the old orders, the old monetary orders, the old domestic political order, the geopolitical order and such things, to cause a seismic shifts. These periods are periods of great risk. They're great risk for the markets. They're great risk for the society. It's very important that they're understood. So that is the world order and the changing world order and the big cycle in a nutshell.
And so the key to that to me is that, listen, it's a super cycle where debts rise relative to incomes. And that's really when we're talking, Scott Bessent says, don't worry, we're going to pile lots more debts on, but our income is going to magically rise up to meet that. And Ray is saying, dude, we're late stage. We already have 100 trillion slapped on the overall economy at this stage, right? Consumers, households, state, federal. All added up, 100 trillion, not including IOUs, right? Underfunded mandates. So we're already saturated with debt. In order for that to pencil out, incomes really have to come up and come up strongly.
They have to come up strongly. But he's explaining, he's clearly explaining where we are in the cycle, where everything is starting to change under the surface. And now what are our interest on the national debts more than our defense spending still? So, we're at that stage in the cycle where it is certainly the most dangerous. And look, one of the things that the young adults, our younger generation is facing right now, they're coming out of college with massive amounts of debt. They're having to take massive amounts of debt to buy homes if they don't have families that can purchase those homes or assist them in some manner. And they're priced out and frozen out because of asset price inflation. And what happens if salaries were to double in the next 12 months? Okay, that's got to ultimately impact corporate profits. So they've got to navigate this perfectly in a completely different manner than what has been able to be accomplished through historical cycles for us not to experience that pain and conflict that he's warning everybody about. You've got him, you've got Stanley Druckenmiller, you've got Jamie Dimon, you've got all of these individuals that are clearly students of history and have clearly been successful, that are warning the citizenry, the governments and individuals, but they're warning individuals, but individuals aren't listening because they're too caught up in the emotions of fear of missing out right now.
I think getting rid of government regulations would be great. I can fix it with a single rule. I'm not against regulations. I think it's good that we don't have, we have clean air and water and all that stuff, right? I think that's fine. But I would I would call up the people at Yelp and I would say, we have to implement Yelp ratings for all our government employees. Yeah. Okay. And then every year, like clockwork, the bottom 10% performing who have the worst customer service, because that's what the purpose of the government, you're there to serve the public. So if Eunice down at the DMV is getting 1-star Yelp ratings, Eunice gets cut next year, right? And so everybody in the government learns you don't want to be in the bottom 10%. You got to get your Yelp ratings up. Next thing you know, Paul, local planning board's calling you up. Hey, Paul, can I help? What's going on? Anything you need that I can serve, what can I do for you? You need some coffee? How can we work this out, right?
Well, and make the regulations clear enough. Look,
yes,
there's regulations for protecting the environment. Could you imagine you can get a 1-star review because planning and zoning, fined you and arrested you for dumping used motor oil into the creek, right? That's clear. But that's a great idea, Chris. I really wish that would be implemented and that would bring accountability back for the government employees. I understand the reason for tenure. I understand the reason for protection because you don't want to have political firings just at a whim. But if you bring it back to serving the people in your Yelp reviews, that would solve that problem.
Mm-hmm. Right? Incentives. I'm going to misparaphrase the paraphrase badly, but because Charlie Munger said, you show me the incentive, I'll show you the outcome. But he had a corollary to that, which was, if you ever find yourself trying to understand something through a lens other than incentives, you're off track.
Yeah. And he was an incredibly successful investor because of his ability to see through and make it as simple as possible, but not simpler, is what Warren Buffett said. When you bring it back to incentives, it does lead to the outcome, clearly. I mean, that's why the government uses incentives for, housing years ago. Let's try to stimulate this part of the economy through tax deductions and incentives. So I like that idea about Yelp, Chris. That's great. You always have these simplified accountability measures that could be implemented, but
well, we would need to turn it back, which is, if you're in a public service role, I think how you serve the public matters, right? So why should we have Yelp ratings for waitresses, but not DMV employees? What's different, right?
That's right.
I had one other thing, but I can let that go. So,
well, I'd say the biggest thing that's hard right now is we're in the summer doldrums. I say summer doldrums, but we're in the midst of summer. You've got kind of these technical flows that are for the markets. We can kind of see GDP is going to be really good in this quarter. Everything's pointing in that direction, but you've got just little things that are creeping under the surface. And the question is, what's the data going to look like in the fall? You'd asked me last week, do I think we're going to end up in a recession in the fall? I don't know. It's hard to quantify how all of these moving pieces are going to unfold in the economy, and it takes some time to get there. I'll be highly surprised if we're not in a recession by early 26. The question is when is the market going to anticipate that? But that's with the information we have now, and I could be completely wrong because we're going to have a lot more information come up over the next several months. But the one thing I want to talk to investors about is really look at your situation, assess where you are, make sure that you're resilient. I don't think this is a time to be speculating. I don't think this is a time to be, and fear of missing out is hard. I've seen what it's done to investors over the years. You got to play the game by the rules that are forced upon you. But but this is not a time to be passive in any way whatsoever, because we don't know how all of this is going to unfold. What if X's in a position to where, it looks like you've clearly laid out that it looks like Trump's panicking. He's awake at 2:00 in the morning, worried about it for sure, that he puts it out there, hey, let me save you a little bit of face because I've tried to negotiate aggressively. I've tried to bully a little bit. So, hey, can we come back to the table? What happens if China just says, Z just gives the big middle finger and says, we'll take a little bit of pain in the short run because we think our citizens are more resilient than what yours are, and we think we're in a better position. And if you weaponize SWIFT or the dollar against us, then we'll just go ahead and turn the key to the other side, and let's see how you like losing the global reserve currency. I'm not saying that's going to happen, but that's something that we have to be concerned about. So it may be summer, but you still have to continue to be diligent in the portfolios and the risk management of where you are. Ride this where it is. I'll tell you another thing. I want to go back to gold. Gold has surprised me, Chris. I was expecting a little bit more of a pullback here in the short run after the run, and especially with the markets being, having this major bounce and, all this optimism coming back in again. But gold's telling us, I was really expecting a 5 to 10% pullback in gold. That's the reason why I was really saying, hey, let's average in over the next 3 to 4 months. But the information is slowly saying gold may have cooled off a little bit, but it's still got enough strength to where it didn't need, at least at this point, a 5 to 10% pullback to gain enough strength to continue. So maybe the bull market in gold is going to continue a lot quicker than any of us anticipate. So it's still telling us, and the VIX is also stubbornly high. It's pulled off a little bit. Volatility index in the market is still telling us that the all clear isn't, the future path does not look as clear as what the equity markets from the S&P 500 seems to be telling it's going to be right now. Now, that doesn't mean that we don't technically hit new highs. We could by July. These technical flows are going to continue to be a tailwind for the markets, at least for now, is what it looks like.
Yeah, but can I confess, I've talked about this before, Paul. That looks like the S&P, but it's not. That's the German DAX. So it's kind of, there's a global something going on here that I don't understand. Of all the places, Germany is sucking wind right now. I understand some of these represents companies that do a lot of international business that happen to be housed in the German DAX index. I get that. But all of that said, this is fundamentally a German set of industries here. And I can't explain this,
I can't either. I've really tried to look and see the justification for that. And there are a lot of countries that I can justify, but not what's taking place in Germany.
Nah, from a geopolitical standpoint, economic, actual internal politics, it's just kind of a hot mess right now. You'd think some of that would factor into the pricing.
And one thing we didn't talk about, Chris, too, that and I don't necessarily want to extend it for the sake of extending it, but here's another risk that's popped up. I mean, there was a major drone attack in Russia, clear escalation by Zelensky. Did the Trump White House know about it? I don't know. But the market's ignoring all of this at this point. And at what time does Putin's patience wear out and he strike back in a severe manner? I don't know. But that's another risk that the market's just absolutely ignoring. And it's been trained to ignore that. So yeah. I'm not saying, to sit around and worry all day long, but I don't necessarily do that. But I am concerned because I'm paying very close attention to what's taking place. And I do not want to be complacent right now. And there are a few areas that we've sold into the rally here in the past week just to lower that risk just a little bit. Mm-hmm. And I believe it's the right thing to do. And if I'm wrong, I'm not going to be wrong for long. I'm certainly not confused. I may be wrong on how this outcome, it may be navigated perfectly, but the risks are continuing to escalate under the surface. And the market seems to be more and more complacent just because of technical flows are causing the markets to work themselves higher. So be diligent.
Yep. As I've mentioned before, I consider this to be highly risky, that whether we're talking about the Dow, the S&P, or the Nikkei, that look at the difference between the S&P and the Nikkei. Just sort of blur your eyes. They might as well be one market, right? Japan is facing a very different set of circumstances from the U.S. right now. I can't think of a single reason why tick for tick their stocks ought to trade just like the United States stock. I mean, it's just tick for tick, right? If I stripped the legends off and scrambled those up, it would take a real expert to sort them all out again. You couldn't remember that, hey, small caps were doing better than Japan last week because there's no difference. It's the same market.
It's the same market. It's operating the same.
It's all one.
Sure
so it's a big Borg of a market, and I don't know how it got that way. That'll be one for future history books and regulators to ponder. But it's one market, and that means it's going to trade like one market, which to me means if anything goes wrong in any one of those markets, let's say Germany crosses the line, Russia's red line, next thing you know, Russia decides that's it, Germany, you're part of this fight, and next thing you know, Oreshniks are raining down on some German drone factory, or Taurus missile factory. If that happens and the German stock market starts to tank, do the rest of them go?
That's a good question.
Looks like it. I think they're all one market.
They're all moving the same. For whatever reason, are they interconnected to that point? I don't know why, but that makes it harder for diversification standpoint. Where are you going to be protected? And if you don't have any gold and something like that takes place, who knows whether gold's going to hold up in the interim period, because it can be pulled down in a liquidity sell-off. But if I had to choose one asset as a protective asset class, and again, not a recommendation because I can't do that, I'm just speaking hypothetically, then gold would be something that is a good insurance piece to have. And silver sure is trying hard to break resistance. That's something I'm hoping by next week we'll have some the ability to talk about, because it's been consolidating for some time, and if it breaks out, we may have the second leg of the precious metals bull market underway.
Paul, back at Peak Prosperity, I've been tracking the energy. I'm an energy guy at heart. So
yes.
Both oil, now we know shale oil is past peak, right? But we now also know that shale gas is, for whatever reason, a little tight right now. And this is what I found just astonishing. So I did find it here. So UBS comes out, they're like, yay, it's going to be a little bullish for natural gas. I think it's going to be bad for U.S. consumers who have to pay for natural gas in their household for heating and cooling. They add it all up. This is astonishing. They say that by 2027, enough data centers are going to be installed to would require 50 nuclear plants to operate. So 50 gigawatts of new baseload power by 2027. 50 gigawatts. Okay, so Denver uses about 800 megawatts. Denver, the whole city. So that's 50 to 60 Denvers by 2027.
By 2027.
So the first question ought to be, well, where's all that electricity going to come from? Because it's not like we have a whole lot of spare capacity just kicking around. We'll just make the plants run a little harder. We're already kind of at capacity. So it turns out nat gas is the most practical, reliable, cheapest power. But I calculated it. If we turned all 50 gigawatt need from natural gas, we're going to need another 8 billion cubic feet per day in 2 years. We have the exact same number of billions of cubic feet coming out of the ground for the past 2 years. So we've had zero increase. The only way we get more natural gas coming out of the ground, Paul, is if it doubles in price, like from 3.5 to 7, and stays there long enough for drillers to get excited about that. So I think we've got a very, very bullish case for natural gas coming, and it's because I don't know that we're really looking at this from a national level appropriately at this point. I hope somebody is, but I don't get the sense that that's happening. They're just like, yeah, it's going to come from natural gas. Like, okay, your next question ought to be which fields, which pipelines? Show me the source for that, because 7 billion cubic feet a day is a big number, right? So Alaska's going to put in this new, like, I forget, 42, 48-inch pipe, whatever, from the North Shore. They're talking about it hideously expensive because it's Alaska and it's got, like, permafrost and all that other junk to deal with. But anyway, $44 billion for this big giant pipeline operating at 2,000 PSI, and it's going to come down, and that's going to be 3.3 billion cubic feet per day. So 2 Alaska projects would be required to make that sentence happen. That's fine. Wow. I just want to know, where are they? Which ones? Is it the Permian Basin? Is it coming out of the Bakken? Are we going to tap the Marcellus a little harder? Is it a Gulf project? Somebody ought to know. I can't find any answer to that question yet. Everybody sort of shrugs.
And you're on top of it, so you would know if that came out. So how does that not inflationary from a supply demand standpoint to the average citizen? Because what are the utilities going to do? How much of that's going to be passed down to the average citizen in that extra cost because of lack of poor planning? Did you say 50 nuclear reactors, right? So what was it Trump said? It was 2032 or 2035 that he would hit the target that they wanted from the small modular reactors that they're trying to get going. Is that correct?
Yeah, but that would just be for the first wave of installs. So between here and there, there's zero new nukes. Well, I mean, there's some small ones that got started many, many years ago that are coming up. I think we have 700-800 megawatts of nuke power coming on, mostly small. But that's it. Well, there's two big ones in Georgia, but I don't know if those are ever going to get finished.
No.
They're already like 4x over budget, and it's a thing, right?
Yeah. They passed down the huge mistake on that nuclear reactor or nuclear plant several years ago to the customers of Southern Company. So curious to see how that goes again. I was quite upset about that, by the way.
Yeah. Did your electricity rates just get jacked up?
It wasn't a tremendous amount, but there was a special assessment for that plant and the whole fiasco, if I remember correctly. I can't remember all the details. It was several years back, but just came to mind. But, there was a fiasco with the development of it, and it wasn't able to go through, and they just passed that down. So it wasn't much, but it was spread across all the customer base instead of the profits of the company. In a situation like that, I'd much rather see the executives take a big cut instead of passing it down to the customers. That's the way it should be. Yeah. So,
yep.
But that's my
Indeed.
question. Is that going to be highly inflation? Is that the next wave of inflation that comes for us as a citizenry? Is much higher utility prices to fund these projects? I don't know. Or are they going to pay for it completely themselves?
Well, they'll just say, oh, free markets, Paul. So, the data centers will have infinite money. So if they have to pay 20, 30, 40 cents a kilowatt hour equivalent, they'll just do that. But for somebody who's used to living on 15 cents a kilowatt hour and suddenly gets a gas bill that shoots their electric bill up to 30 cents a kilowatt hour, it's going to be quite shocking, And we'll say, oh, that's the markets at work. Like, no. That's bad planning at work. That's what that is.
Bad planning at work.
Let's just be clear about that.
I will say a natural gas bull, it will not be good for those that are having to purchase it, but for those that have the ability to participate in it. I remember the last one that occurred in early, in the 2010. It came apart around 2000 in 2008. That was a fun one.
Yeah, that one shot way up. But again, that was because from 2007 up through the second quarter of 2008, we'd had out of 6 quarters of production, 5 of them were just slightly below what we needed. So demand exceeded supply, just slightly. Not a lot, but we were eating into reserves. Now, what normally happens in that situation, Paul, is prices are very inelastic. They shoot up like crazy because you can't tolerate that. Perversely, this past 4 quarters, we've seen the lowest levels of inventory for oil in the series in a long time, like way down at the bottom of the 5-10 year ranges, like really down. And pricing has been weak. It's a very odd combo.
Mm-hmm. And price got hit hard yesterday with OPEC's statement. I didn't get a chance to read the statement about they were going to produce more oil, right?
Trump went over there. Next thing you know, Saudi Arabia is announcing how much more oil is going to be coming out of the ground. Like weekly, if not daily, right?
Have you checked on the strategic petroleum reserves? Have those been refilled?
Not refilled. They are climbing again, very slowly and steadily, but not refilled. This was on Art Berman's blog. This just came out, I think, this morning or yesterday. So we have 2 things here. On this chart. This is the spot price for West Texas Intermediate going up the left axis. And then here we have comparative inventory along the y-axis. 0 is right here in the center. So comparatively, we might have 50 million barrels or 100 or so on stretching out to the right, or we might have minus 50, minus 100, et cetera. So it's supply and demand, right? Price and supply. So how much you got and what's the price? And normally you see these things adhere pretty tightly to this curve, right? We got off this curve pretty far for COVID because that was total wackadoodle, right? So prices were lower given how much inventory we had and all that stuff. But down here is weird. These are the most recent dots for the red here for 2025. This departure is as significant as the COVID, and the COVID was the biggest shock to the system ever, right? We suddenly stopped flying, we stopped driving. They had remember oil actually went negative $40 a barrel at one key point in the middle of that because it was still coming out of the ground, but we weren't using it, so there was literally nowhere to put it. They'd pay you $40 to take the barrel away because it was about to slosh over onto the ground and cost them $200 to clean it up, right? So whatever, it was a crazy moment. We're as crazy as the craziest moment ever right now. That's how crazy it is. How did we get this crazy?
That's a good question. That's a really good question. But it also presents a very interesting opportunity as well whenever those dynamics start working themselves back towards the trend. That's very interesting. What's your explanation, Chris?
Well, to not be conspiratorial about it, it would be that there's just a lot of uncertainty and that, Trump's jawboning it down. And you just sort of get this narrative structure in place that's just sort of self-reinforcing, right? So everybody's short oil because everybody's short oil, and it confirms itself because every time oil seems to lift up, it gets shorted again and it goes down. So those things tend until they go the other direction, right? You were mentioning 2015 here, we had a false rally there. Those big giant spikes you were talking about are all contained in here. But otherwise, you should be right on this line for the most part. Very tiny departures. This is max pessimism in 2016. We were way down off that line. This is as bad as it gets. I mean, that's as far from the line. So the answer is we're going to get back to the line. But if we just in 2025 went back to the line, we would go straight north from here, and we'd be at about $90 a barrel. And we're currently at about 60. So that's not insignificant. That's a 50% increase. We're about 50% off of what history says we ought to be at. So the conspiratorial view is that somehow government has figured out, in cahoots with some trading firms, how to keep things like silver and gold suppressed, and oil too, right? You just work with your buddies at some big CTA, commodity trading advisory firm, and wink, wink, nudge, nudge, and you have them slam oil because you want it to be cheaper for some reason.
It would work ridiculously well in this environment from that standpoint because momentum strategies are really that's the large majority of what's winning in the markets right now. So everybody's kind of on that same bandwagon of momentum. If they've done it with gold prices. I mean, there have been judgments throughout the courts with JP Morgan traders that we're manipulating that price. So if they're doing that in the oil markets, that's short-term gain for long-term pain, a short-term benefit for a lot more pain from a long-term standpoint. So go back and think about what gold prices did for quite some time. If that was taking place and that's where they learned it over there, and how quickly the gold prices moved, what's that going to do to the economy and inflationary pressures if at some point in the future oil follows that same chart after being artificially low for an extended period of time? Because that's going to reduce investment, because it's less profitable to tap in. Even if they're out there, are you going to drill with prices this low? You've talked about that before, Chris.
So Art says comparative inventory offers a useful perspective. We just looked at that chart down there, but said for most of the past decade, oil prices tracked inventory levels along stable yield curves, dash blue line in figure 3, that one which we were looking at there. He says that pattern has unraveled. Since 2023, price discovery excursions away from the line have become more pronounced, and in 2025, all those red circles we were looking at, volatility has rivaled the COVID collapse. Only now it stems not from a single shock, but from chronic systemic uncertainty. Today's market isn't just responding to fundamentals, it's groping for meaning. Inventories are well below 5-year averages, offering little cushion, and rather settling back to trend, prices now swing widely in response to shocks, geopolitical, structural, narrative-driven. So, sounds a little chaotic.
Yeah.
I think it represents opportunity, but that's me.
Yes. Well, not a recommendation. I'm itching for the moment that we get to allocate towards the energy space. And I don't know when that'll be, but there's a tremendous amount of opportunity there, especially as the rebalancing occurs. And one thing that may happen is money may just shift from one area to the other. And if it shifts from the popular themes now to some of the underpriced themes like energy and others, for those that have the ability to adapt and shift their portfolio to benefit from that, will be better protected than otherwise.
Well, you know, if you could have picked where the gold mines were, that would have been great back in the day. Or you could have just sold picks and shovels, right? To the gold miners. So pick how you like to play the game. I'm more of a picks and shovels guy when it comes to this story. I don't know which data centers and which AI system. I don't know. I don't even know what it's going to do. But I'm positive that the companies selling the HVAC, the chips, and the gas needed for the power into that, they're all going to make money. Guaranteed.
Mm-hmm. Because that investment is going to continue. And
yep. All right. Well, with that, Paul, any last words or?
No, that's it. I threw enough wrenches in there for the day.
All right. Very good. Well, thanks everybody for listening. By the way, you will see Paul and I at our Peak Prosperity Annual Summit, which is September 12th, 13th, 14th, Lake Winnipesaukee, New Hampshire. You are invited as long as you love truth and you would like to meet Paul, myself, Evie, and a whole bunch of other cast of characters who are going to be presenting. It's a great time. It's a good, fun time. It's kind of feels like family, like the family you always wanted to have. And it's just a wonderful environment. So you're invited. Go to peakprosperity.com. Check out the summit if you're interested in coming. Tickets fill up pretty fast. We sell out every year. So if you're interested, they've just gone on sale. Paul, otherwise, people, if you want to talk to Paul and or his team, go to peakfinancialinvesting.com. There's a simple form there, very easy to find. Click a button, fill it out, and within 48 business hours, somebody from Paul's office will call you, set up a time to talk. So again, peakfinancialinvesting.com, and hope you take advantage of that because Paul and his team do amazing work for people. Even if you don't end up working with him and his team, you will get a lot out of the consultation and the planning that Paul puts into every single person.
It's so rewarding because so many people understand the reality of their situation, and that itself's worth the time to go through it each time. And before you close, I will say this: your annual summit is one of the most enjoyable events that I ever go to because of the conversations. I mean, people who care, they're seeking truth. It's unbelievable. So for those of you that have not been, I'm just going to encourage you to go because you'll meet wonderful people and you'll be encouraged about how many people that actually care about knowing the truth and the future and the solutions that you can better prepare yourself for. It's a great event, Chris.
Thank you. I'm super looking forward to it myself. Always am. All right. With that, thanks everybody. We'll be back next time. I hope you enjoyed this, and please trade safe and make sure that you are resilient and protected and ready for whatever may come. Until next time, bye for now.